Welcome all friends, bears, followers, subjects. This is the daily recap show, and for those of you that are new here, this is how things normally go. Me, your host, Chase, will say various things. The stock market will go ahead and do those things. You will then go make some money. Got it? Good. Let's go. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very mixed day. The S&P 500 closed unchanged pretty much on the day. However, it did notch an intraday all-time high as the market awaits the Fed meeting tomorrow. Let's just take a sector like technology. Look at Microsoft up, infrastructure tech fairly red, excluding Microsoft. Apple was flat, semiconductors, Nvidia, AVGO were red. The broader semiconductor market was green, same with manufacturers. So that type of price action reverberated throughout the whole market. I mean, look at stuff like financials, very green in banks and credit services, financial data asset management, not as red. So just going into the uncertainty of the Fed's decision tomorrow. Looking at the best performing sectors, energy up 1.3%. The worst performing sector was healthcare and staples, both down 1%, both defensive sectors, along with utilities being in the red. So the market definitely positioning themselves in more cyclical and sensitive sectors versus defensives. Still a 50-50 day nonetheless. Energy, industrials, discretionary, financials gained. All the other sectors lost. Like I said, 50-50 day in the market, but that was mostly large caps. We saw mid caps and small caps actually post up very nice gains, particularly small caps. They were very strong across the factor segment. Value, core and growth put up a very solid day in small and mids. Large caps, not so much, and that was driven by some economic data we got today. August retail sales came in significantly better than expected, boosted by rapid wealth gains and falling energy prices. Consumers continued to then spend freely. Retail sales was up 0.1% versus the forecast where it actually fell. A bit more mixed if you exclude autos, but the headline figure right here gained on the month when we were expecting a steep loss. On top of all of this, retail sales in July were revised to a 1.1% increase from a prior reading that just showed 1%. So we got up revisions in prior months, stronger than expected data today, and that really supported a lot of the price action we saw in the market today, especially in the smaller and mid-cap segments. We also saw upbeat data in industrial production, capacity utilization, business inventories, and the home builder confidence index. On the rate cut front, there wasn't significant changes from yesterday. The market is still expecting a 44% chance to cut 25 basis points tomorrow and greater than 25, a 59% chance. Only 1% of market participants actually see no cut tomorrow. Very weird. So we're still kind of 50-50, but leaning to a rate cut that's probably greater than 25. That's likely going to be a 50 basis point rate cut too. And the best performing sector today here was the IWM by far, up 0.83%, upbeat in the after hours as well. But we actually saw equity markets across the board gain, even if it was so marginally. The S&P 500 and the Nasdaq 100 were pretty much flat, up 0.03%, but the S&P 500 did put up an all-time intraday high. Very constructive. That was part of the weekend plan. We actually said we'd probably go ahead, break these highs. We didn't get the close, but we did go ahead and break them, and then we were going to see a sell the news event into the rate decision, depending on if it was a 25 or 50 basis point worth of a cut. Tomorrow, that will determine if we get the sell the news event or if we're just going to continue to move higher. We'll see how that plays out. We don't want to predict what happens. We want to react to the market, and the reaction we want is sort of a pullback to buy the dip into what is going to be a strong end of year run. Now, the RSP, the equal weight market, actually did gain 0.15%, but look at the movement here in the after hours. Very strong momentum, and the RSP, like the S&P 500, actually had a new high today, although it was a closing high for the equal weight. Very constructive. Mid caps were up 0.5 percentage point, the S&P 600 up 0.77%, and on the back of stronger data, yields actually rose ever so slightly. already. The 2-year yield, 10-year yield, and 30-year yield all gained, but it's inconsequential really because rate cuts are coming tomorrow. The market just deciding if it's going to be 25 or 50, and that stronger data really did help the market. The dollar did actually gain after being quite a dumpster fire yesterday, so a bit of a relief rally there, and both gold and silver actually falling in today's trade, down 0.5 percentage point. Actually, silver pretty much flat. I wouldn't call that a fall of 0.1%. Commodities can be volatile, but the S&P 500 put up a new all-time high. We also saw a new all-time high here in the advanced decline line. That's very constructive. It's pretty much what I said on the weekend video. We're going to go ahead, break these highs, notch a new all-time high. We did that, and pretty much this means that this higher low is now confirmed with a higher high, new all-time high. Very constructive price action. And if we do pull back, so we just want to be a buyer of dips, and we may actually pull back tomorrow. We saw quite a lot of hedging under the hood. The gamma flip zone, which was at 55.70, actually moved down, meaning that there was a little bit of buying protection under the hood, which actually moved the gamma flip a little bit lower. It does mean we have more room to pull back into support, but what that's telling us is that if the gamma flip moves down, there's a lot of hedging positions, long put positions that were bought that actually move that down. It's just how dealers hedge their books accordingly, and that's why we saw that market movement right there. The put support and call resistance continue to be at the 54.50 area and 56.75 area. I don't think we're actually going to see these move until probably after September OPEX, but if they do, you will hear it first here on this channel, so go ahead, subscribe so you don't miss a beat, guys. But with the S&P 500 pretty much trading at the call resistance, I think there's asymmetrical downside now in the market. Unless this actually does move up, we probably should see downside to the gamma flip here on the 55.50 area. This is not me getting bearish. I'm just saying that the probability suggests that we do see downside based on my gamma charts. Looking at the Nasdaq 100, very similar situation, still in positive gamma. We did go ahead and wick above the week's high so far, but we actually didn't go ahead and break this high, and the price action here still looks very flip-floppy. For any trend to form in the Nasdaq 100, you really want to see the market go ahead and break this level right there. That's what you need the Nasdaq 100 to do, to go ahead and confirm this as a higher low, and then to go ahead and break new all-time highs. But looking at the IWM, pretty constructive. I mean, all things considered, this is now looking like an equal high. We just need a couple more days of just the IWM to sort of just push above this level right here, get a close. We do that, and like the S&P 500, we've confirmed this higher low, and that opens up the 52-week highs for the IWM. And you can see here, put in a low, higher low, higher low, higher low, and now we're trying to go ahead and break those highs. Very constructive. And the RSP, the best looking chart, up about 0.5 percentage point here in the after hours. Very strong. So the stock's trading at about that level in the after hours. A new all-time closing high, very strong. Looking at the advanced decline line, a new all-time closing high, and I think this is actually going to continue. I think the RSP is going to continue to outperform in this tumultuous period and towards the end of the year, but I think we're going to have a broad-based rally into the end of next year. Guys, we also saw the VIX up 2.74%, often leading up into OPEX. You do see VIX up, stocks up, a bit of that divergence. And again, that goes to signal just a bit of the hedging effects we saw under the hood with the gamma chart that I showed you earlier. So there's definitely still bears lingering under the hood. I think a lot of people are just hedging into a sell the news event tomorrow, and that actually might occur. But as it is right now, our gamma chart is telling us that there is asymmetrical downside to the 55.50 area unless the call resistance moves up to the 5700 area or above. You could definitely see weakness to this area right here, but you should just really buy the dip unless we actually have a close below the 55.50. Then that does open up the put support. But if we do get there, I'll give you guys an update. There's no need to rush. We're about 80 or so points away from that, and we probably likely, if we are going to have a massive sell tomorrow, we probably are going to find support at this area, and then we'll discuss what happens next. But for now, things looking very constructive. That's a new all-time high, and there's nothing more bullish than new all-time highs. Look for pullbacks, buy dips on assets you like. I particularly like half in the small cap space. I like the ticker moat in the mid cap space, and I like the RSP in the large cap space. But to be honest, buying the Nasdaq 100 right here, I think these stocks are still going to really outperform. Buying the Nasdaq at these levels right here probably does mean you might get outperformance into the end of the year. So those are the tickers I would look at: the QQQs, Nasdaq 100, moat, and the the calf index if you're looking to get exposure at these levels. Bonds could also be a good play. TLT was down 0.5 percentage point today, sitting at the $100 level. If we do get, let's say, 200 basis points worth of cuts, which is currently priced into the market, we could see TLT at the 120 area by the end of next year. And at the same time, you're going to collect anywhere from a 3 to 4% yield on top of that. Very, very constructive. So if you are looking to diversify a portfolio, look at bonds and also look at gold. And looking at market sentiment, this is Bofa's bull bear indicator, something we look at a lot on this channel, and it's just a comprehensive gauge of overall market sentiment. It really just provides us insight into investor behavior and potential market trends. It's not a crystal ball, but it does allow us to assess probabilities, and it's constructed on a bunch of various factors like these right here: HF positioning, credit market technicals, equity market breadth, equity flows, bond flows, and long only positioning. And you can see that every single one of these sentiment components is in neutral except equity flows, which is in the bullish territory. This right here is just the Bofa bull bear indicator back tested. You can see it has a very, very good track record. Now, a higher reading on the indicator suggests more bullish market sentiment, vice versa on a lower reading. And the indicator this week dropped to 5.5 from 5.9, telling us to remain cautious for the rest of September. We also see stats like these from Fundstrat. The first 4 trading days of September, when they're negative, the S&P 500 in September normally goes 0 for 10. There hasn't been a single instance where the first 4 days were negative and September ends up in a positive. Trends are meant to be broken, but the probabilities tell us that we should expect more volatility leading up into the FOMC, leading up into the rest of September, because we are in the worst 2-week period in the year. The second half of September tends to be the worst. This doesn't actually have a date right here, so I don't know what that exact month is, but September 2nd is either the worst or the second worst 2-week period in the year. So do be prepared for volatility, remain optimistic yet cautious, and you do want to buy the dip, however, guys, because average returns when the market does pull back. Now, this is a 20% dip. I showed you guys a 10% dip yesterday, but when the market does pull back and we do get these volatile moments in the market, you do want to buy the dip, because 6 months, 3 months, and 12 months later, we see outside returns relative to the average. And while it does balance out 2 years and 5 years in the future, you do want to take advantage of these immediate dips because you generate almost instant alpha. But if you are looking to diversify your portfolio, then you should definitely look at something like gold. Goldman see gold to 2,700 by early 2025 because of these 3 factors. Firstly, they believe the tripling in central bank purchases since mid-2022, driven by fears about US financial sanctions, sovereign debt, is structural, and they believe it will continue whether reported or unreported. Fed rate cuts are poised to bring Western capital back into gold ETFs, a component largely absent from the sharp gold rally observed over the last 2 years. And pretty much they're saying we think retail investors and institutional investors are going to join the fold buying gold and not just central banks. And then the third reason, gold offers significant hedging value to portfolios against geopolitical shocks, including tariffs, Fed subordination risk, debt fears, recessionary risks. And our analysis suggests additional upside of 15% in gold prices under a hypothetical rise in financial sanctions, equal to the increase seen since 2021, and a similar upside if US CDS spreads widen by 1 standard deviation, 13 basis points, amid rising debt concerns. So there is your bull case for gold by early 2025. And if rate cuts continue on the path that the Fed will allude to in the middle of this week, we could even see 3,000 gold by the end of 2025. Not my prediction, just saying what I'm seeing in the data. And diving into the macro, guys, very interesting. Global GDP has not changed since I last showed you this about a month ago. We're sitting at about the 2.7% in global GDP. What has changed significantly, though, is China's GDP right here. The Chinese economy continues to struggle. GDP forecasts have been revised down significantly. And guys, while China stocks do look cheap, I wouldn't go in buying the dip just yet. You really have to see if China can weather through this economic recovery. It's taken a lot longer than people thought it would. And the best place to put your money right now is probably the Euro area, as well as the US and other economies, maybe stuff like Canada, Australia, maybe Taiwan, Malaysia, the semiconductor belt of the world. But the West hasn't been impervious to weak economic data. In fact, for most of 2024, we've actually seen softer data compared to analyst economist expectations. This is the 0 mark right here in the economic surprise index, and pretty much anything above this line suggests stronger economic surprises or stronger economic data. Below means weaker than expected, and we have seen economic data being very soft for nearly all of 2024 since about the March area. However, we have seen an uptick in economic data, and while we are still below the 0 line, this is moving in the right direction. But does the data tell us that we're going into a recession over the next 12 months? Well, this is the market implied US probability indicators, and only one of them is telling us we could see a recession. The 12-month forward implied change in the Fed funds rate sitting at 98% probability of a recession in the next 12 months. The average is 39%, probably skewed by this data point right here. I think if this was probably more normalized, if the Fed maybe cut last, I think if this was probably more in the normal range, this figure right here would be closer to 30, maybe 25%. Most indicators aren't really signaling a recession. You could see that stuff like the 10 to 2 year spread, MBS spreads, cyclicals versus defensives, the VIX, not really screaming recession signals. It's really just the Fed funds, which I think the Fed are a little bit behind the curve. And that's why this is signaling a recession right now. But to me, what it's signaling is that the Fed need to cut because real rates are too high. If we then actually go into daily and weekly data, we can see that things aren't signaling a recession. Looking at daily data, restaurant bookings, air travel, and daily debit card data are all very strong. That's positive for the consumer. Weekly data, GDP now and the GDP index at 2.5, 2.3%. Retail sales has been very strong this quarter. Jobless claims trending sideways, I would say down to sideways. Hotel occupancy rates are strong. Bank lending to firms and consumers is growing. The M2 money supply is growing, guys. Bankruptcy filings are trending lower. Credit card data is solid. Global jet fuel demand is weak, slightly weak. Broadway show attendance is strong. Box office weekly grosses is strong. Forward profit margins for the S&P 500 near record highs at 13.3%. Business formations is rebounding, and ASA temp work staffing index is trading sideways. If you want a recession, you need to see a lot of these strong numbers right here signal sideways to weak, and you have to see GDP fall below 2% and the consumer look a bit weak. We are not seeing that yet. I don't think a recession is coming. We are going to be data dependent. That's what we do on this channel. We look at the data every single day, but to me, it doesn't scream recession just yet. And at the end of the day, guys, 90% of the time we avoid recession, stagflation, and all of that mumbo jumbo. It's all just media noise. You want to look past it, buy the dip in high quality assets, and sit through the volatility. Looking at earnings for the rest of the week, we don't have a lot. Tomorrow we just have General Mills. That's about it. Thursday, FedEx, FactSet, and Lennar. A very light week in earnings, but a huge week in data. Guys, tomorrow we have the FOMC rate decision, as well as Jerome Powell speaking. We get the dots as well to see what long-run projections as well as short-term projections are going to look like for the rest of the year, as well as 2025. We also get housing starts and building permits. The expectation forecast there is 1.31 million and 1.41 million respectively. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.